Okay, so you want to buy a cargo ship, a giant steel behemoth carrying 20,000 containers across the Pacific. That is the dream. But here's the part nobody tells you. You're not actually in the transportation business. You're in a very high-risk game of leverage. A single bad day or a minor diplomatic spat on a channel can wipe out your $100,000 before the sun goes down. That's very painful. The world's largest shipping lines survive because they have mastered the art of charging others for the privilege of waiting. By the end of this video, you'll learn exactly why a brand new Megamax ship is actually the cheapest part of getting started in this business. You'll discover why lying idle in the harbor costs more than a luxury apartment and how high prices can ruin your bottom line. We'll delve into the harsh realities of fuel costs, secret cartels, and the harsh realities of war insurance that turn trips into nightmares. Welcome to the Capital Expenditure Insider. Here's the economics of owning a container ship fleet. Container ships come in three distinct sizes. For their billionaire owners, they represent three entirely different financial realities. First, let's take a look at the feeder ship. A new one of these regional cargo workhorses, which carries 3,000 containers, costs approximately $20 to $40 million. Next up is the Panamax vessel. Priced at up to $90 million, these ships are designed to pass through the narrow Panama Canal locks without any issues. And next up is the big brother, Megamax. A $250 million floating mountain that carries more than 24,000 containers along massive global trade routes. However, writing this massive check is only the first step. The largest Asian shipyards have a legendary backlog of global orders that spans years. Older ships consume significantly more fuel, require constant dry dock repairs, and struggle to comply with modern international environmental regulations. If you don't want to wait that long, you can buy a used ship. A 10-year-old Panamax will cost half the price. But there's a dangerous financial pitfall here. Because the moment that hull hits the water, the depreciation clock starts ticking, and your daily operating bills are about to come as a shock. Your first and most daunting daily expense is fuel. These massive ocean giants don't run on standard diesel, they burn bunker fuel. A fully loaded Megamax ship consumes up to 150 metric tons of fuel every day just to maintain its speed. At current market prices, filling your tank for a single Asia-Europe trip would easily cost well over $1 million. Next up is your crew. It takes 20 to 25 highly qualified professional sailors to ensure the safe operation of a typical large ship. Among captains, chief engineers, and officers, your daily crew payroll, including meals and rotation logistics, costs $5,000. However, the real profit margin killer isn't the open ocean, it's the port. Ports charge exorbitant fees just to dock your ship at the pier. For every hour your ship sits idle waiting for a crane, you're paying thousands of dollars in port congestion fees and berthing fines. To cover these daily costs, you sell space on the ship. You charge fees to massive industrial conglomerates for safely transporting heavy automotive cargo and electronics. You calculate your profit based on container volume. If you manage to fill the entire 24,000 space, the math looks incredible. In reality, however, a ship is rarely 100% full. A decline in global consumer demand can instantly ruin your load factor. Suddenly, you find yourself sailing a half-empty steel behemoth across the ocean, paying the full cost of fuel while earning only half the revenue. And that brings us to the most dangerous part of it all: the secret maritime alliances that control the price of your survival. You might think the shipping industry is a free market where anyone can compete. In reality, however, three major alliances, which operate in the utmost secrecy, control almost everything. These cartels are known as 2M, Ocean Alliance and The Alliance. Together, they dictate the routes, schedules, and pricing for 80% of global trade. As a ship owner, you must choose between two financial worlds: the highly volatile spot market or long-term, stable contracts with global retailers. Long-term contracts provide stability and ensure that your daily operating expenses are covered. However, if freight rates suddenly spike, you'll miss out on massive potential profits. During global supply shocks, container prices can skyrocket from $1,500 to over $20,000, creating overnight billionaires. When the market reaches these historic highs, even the oldest and most rusty cargo ships turn into gold mines. Their owners postpone their plans to scrap them just to make a few more voyages worth a few $1 million. However, this sudden surge always triggers a major operational trap. Every shipping line, seeing the incredible profits, simultaneously places orders for brand new, massive ships from Asian shipyards, completely overwhelming the future market. Because it takes shipyards years to build these giants, new ships are delivered just as global consumer demand begins to cool, causing a sudden, devastating collapse in container prices. To protect themselves from this ruthless cycle of rise and fall, major alliances employ aggressive, covert strategies to artificially manipulate global capacity and prevent prices from plummeting to zero. Understanding these cartel mechanisms is the clear dividing line between a failed amateur and a battle-tested billionaire shipowner who knows how to survive in the global trade game. Even if you master the built-in Excel spreadsheet and form alliances with the largest cartels, your multi-million-dollar assets will remain entirely at the mercy of unpredictable global bottlenecks. These geographical choke points are the narrow waterways that control the world's wealth. When a single channel is blocked, the entire global logistics network suffers a catastrophic breakdown. Take the Suez Canal, for example. More than 12% of global trade passes through this single canal in Egypt. When a ship runs aground there, it brings $10 billion worth of daily trade to a standstill. The second option is to change course. You completely bypass the blocked channel and reroute your massive ship around the entire African continent via the Cape of Good Hope. This choice ensures safety in geopolitical conflict zones, but it adds 10 long, grueling days to your journey and immediately burns through over $1 million worth of extra bunker fuel. To make matters worse, your customers are angry. Your retail inventory is stranded on your delayed ship, which means you've missed your tight delivery windows and are at risk of losing multi-million-dollar long-term contracts. And if you choose to brave the danger zones rather than change course, your war risk insurance premiums will skyrocket by 500%, completely erasing whatever small profit margins you have left. To see how all these chaotic operational and geopolitical variables affect your bottom line, we need to open the main financial Excel spreadsheet and compare the two different realities of owning a shipping fleet. Let's look at the optimistic scenario first. The global consumer market is picking up. International trade volumes are at an all-time high, and port congestion on major routes has been completely eliminated. Your brand new Megamax vessel sails fully loaded every time. Freight rates are fixed at a premium of $5,000 per container, and bunker fuel remains inexpensive. Under absolutely ideal conditions, a single round-trip flight could easily generate over $20 million in pure net profit, allowing you to recoup your entire investment in record time. But now, let's turn that Excel spreadsheet into a grim, realistic scenario that wipes out small shipping companies every 10 years. The global economy slows down, and a sudden market crash hits. Suddenly, consumer spending in Europe and the United States drops, causing your occupancy rate to plummet to 60%. Fierce price wars force you to lower container prices to $1,200. Now, look at this dire math. Your gross revenue is instantly cut by more than 70%, but your fixed operating costs remain exactly the same. You're losing millions of dollars every week. To make matters worse, you can't just shut down a massive ship to stop the bleeding. Even towing a ship to an empty port and leaving it there costs thousands of dollars a day due to basic safety and payroll expenses. In less than 6 months after a global market crash, all your cash reserves will be completely wiped out. And you'll be forced into ruthless debt restructuring negotiations with international banking giants just to survive. And that brings us to the biggest, best-kept secret of running a fleet of cargo ships. This isn't really a shipping game. It's a ruthless game of capital endurance. The billionaires who rise to the top in this industry are not the ship owners with the newest or fastest giant vessels, but those with financial resources deep enough to weather years of market turbulence. If you want to uncover the ruthless economics and hidden mechanisms behind the world's most capital-intensive global industries, be sure to subscribe to the Capital Expenditure Insider. See you next time.